Hello, once again, options traders. Good morning, everybody. And a question that I get a lot, more from our newer traders: why didn't my limit order get filled when others did? And what they're talking about is they might see that on time and sales that they saw some trades execute, let's say at $3, and they had a limit order in at 3, but they didn't get filled. Or maybe they had a limit at $3 and their friends got filled at a different broker, and they say, hey, is something wrong with my broker? Why did they get filled, but I didn't? Well, it's an understandable question. It's a good question, but it comes with a very simple answer, and you need to understand this if you're going to succeed in the markets. So let's go find out the answer. Why didn't my limit order get filled when others did? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, a little refresher about the two basic types of orders you can use whenever you're placing trades, whether for stock or options. We have a market order and a limit order. A market order guarantees the fill. So, if you place an order at market, it will absolutely get filled. But for that benefit, market orders do not guarantee the price. You can't be 100% certain which price you'll receive. Might be a little higher price, might be a little lower price. It's usually going to be very close to the price you see on your broker's platform at the time you place the trade, but it's not guaranteed for reasons that you'll see in a moment. So, for example, let's say that the stock is trading for 100. You place an order to buy 100 shares at market. As soon as you press that enter button, you will get filled immediately, but again, not 100% sure of the price. But one of the points to get from this, if you must get in or out of a trade, use a market order. I know a lot of people say, oh, you never use a market order, always use limits. Well, that's not necessarily true. Market orders are a tool, and if you're trying to put a trade in at 3:59 p.m. Eastern Time right before the market closes, you're probably going to have to use a market order, or just understand there's a very good chance it won't fill. So they do have their place. Now, if you don't like the idea of not being 100% certain about the price, you do have a tool against that as well, and that is called a limit order. So with limit orders, you guarantee the price, but you do not guarantee the fill. So for example, let's say the stock is 100, you place an order to buy 100 shares at a limit of 100. Well, it's not guaranteed to fill, even though that's the current stock price. But the one thing you are guaranteed is to not pay more than your limit. In this example, $100. So if you're on the sell side, it's just the opposite. You will not receive less than. So if this were an order to sell 100 shares at a limit of 100, you know that the minimum price you would get is 100. You might get more, but you won't get less. So the point to understand with limit orders, if price is critical but not the execution, then by all means use limits. Now, once you understand that basic setup for the markets, you're going to find out that the stock market, the options market, are what are called limit order driven markets. That's what you're seeing in your broker's platform. And the second thing to understand is that it's an auction, very much like eBay. So take a look at this listing I found on eBay. Here's for a Logitech mouse, but the point to look at over here, what do you see? 3 available. See, there's not all the supply in the world that you might possibly want. It's an auction. At every single price, there is a limit on the bid and a limit on the offer. The limit might be quite high, but it's still a limit. So this is part of the puzzle right here, is to realize it's an auction market and there's not an unlimited supply at the bid and the offer. So let's take a look at an example of what's called the limit order book is being created. Now, in today's world, it's all electronic, but back in the day, it was with market makers, but it doesn't matter. The idea is exactly the same. Let's say that you place an order to buy 5 calls at a limit of 3. So this is your limit. You know that you're not going to spend more than 3. You might get filled less, but you won't pay more. So here's the way that these orders get stacked up in the limit order book. So let's say that this is our computer monitor, and just to make it very simple, we're going to assume that there are no existing trades on the book. So the monitors are going to show a bid and an offer. This will be for a specific stock, maybe Microsoft, or it's for a specific option, a particular expiration and strike. Each one will have its own little book. So let's say that an order comes in to buy 5 calls at a $3 limit. Well, remember that buyers place bids. So this order is going to get stacked up over here under the bids. This number in the parentheses is the number of contracts that this trader is willing to pay. Another order comes in to sell 5 at a 320 limit. Well, sellers place asking prices. So this person's going to get stacked up over here. 5 contracts this person's willing to sell at 320. Another order comes in, buy 8 at a 280 limit. So this price is not as high for a buyer as this person. So he's going to get stacked below. So the buyers place bids. We know that this order, because it's a buy, will get stacked on the bid side, but we also have to place them in order. Who is the highest bidder? That person gets priority in line. If 2 or more traders come in at the same price, let's say somebody else comes in at 280, then they get stacked according to time, what's called time priority. All right, so let's say another trade comes in to sell 7 at a 330 limit. This is a seller. Now notice that this person's limit is higher. For the sell side, we'd like to see lower prices. Those are more competitive. So this order does go on the books, but it's going to go above the low offer right here, the low asking price. Another trade comes in to buy 4 at a 290 limit. Well, notice this person's a little higher than 280, but not as high as 3. So that person's going to get stacked in between here. So that computer's going to stack him up over here. Another order comes in to sell 10 at a 310 limit. Sellers place asking prices. Where do you suppose this person's going to go? Remember that for the sell side, we like to see lower prices. Well, 310's the lowest out of all that we have so far. So this person gets to go to the front of the line. So he's going to bump everybody else back into line this way. So the point is that these orders happen very rapidly. We could have thousands or tens of thousands really in a matter of seconds. But this is the way that the computer stacks them up. There is a fixed set of numbers. It's not all that you want to buy or all that you want to sell, because we're relying on individual traders to place these bids and offers. So what you're looking at on your broker's platform when we see our quote for, let's say, this option, is this. We're going to see the high bidder. We're also going to see the low offer. And that's usually why they stack these up in kind of this reverse order. So the quotes at the center of the screen are what are called the inside quote. So again, this is what you would see on your broker's platform. So this is a particular option, certain expiration and strike, and it says there's a bid of 3 and an asking price or an offer price of 310. But just because that's what your broker's platform shows you doesn't mean that's all there is. This is kind of behind the scenes or behind the curtains. This is actually what's called level 2 quotes back in here. All of these quotes except for this one and this one, those are all behind the scenes. They're orders that are on the books, but we just don't see them. Now there's another little set of numbers you need to understand called the size. It's always shown as a pair of numbers, let's say 5 by 10 in this example. The first number corresponds to the bid, second number corresponds to the ask. And you'll see that on your broker's platform, whether you're looking at shares of stock or options. So what we're looking at here is it says that for the bid, there are 5 available. That's what 5 means. Remember, the first price is for the bid, the second is for the ask. So if we see 5 by 10, we know on the asking price, there are 10 contracts available at 310. Now, these numbers right here are going to, in most cases, blink very rapidly. You're going to see 5 by 10 and then 7 by 2, 4 by 8. They're just going to go back and forth as these trades are either getting picked off or new ones are being entered. Now, keep in mind, if you are looking at shares of stock, the actual underlying, these would be in 100 share lots. So if it says 5 by 10, that's really 500 shares on the bid and 1,000 shares on the offer. But if you're looking at contracts, at options, they are the number of contracts. So here we see that there's 5 calls available that somebody is bidding for at 3, and there are 10 contracts that somebody is willing to sell at 310. Now, what if we have another order? Let's say you come in to buy 10 at a $3 limit. What happens now? Well, you're tied with this person. Well, your broker's platform will now show that 15 contracts are being bid for at 3. That doesn't necessarily mean it's the same person. So even though you might see very large sizes down here, 200 or 5,000 or something, doesn't mean it's one trader. But we have a total of 15 contracts that are being bid for at $3. And that means that our size over here would change to 15 by 10. Okay, let's say that another order comes in to sell 10 at a 330 limit. It's a seller, and this person matches an order that's already on the book. So what's going to happen here? Now this is going to go from 7 to 17. But notice that our quote isn't going to change because the high bid is still 3 and the low offer is still 310. So the size down here is not going to change. It's going to stay at 15 by 10. So this person doesn't alter the quote, but they do get recorded on the books. Every order has to hit the books. All right, let's try another one. Let's say another order comes in to sell 3 at a 310 limit. What happens now? Well, this person matches the low offer price. So now it's going to go from 10 available to 13 available. So we go from 10, we're going to add these 3, so it's going to show 13. And of course, the quote doesn't change because that's still the low offer. But the size will change. It's going to go from 15 by 10 to 15 by 13. All right, now let's take a look at some market orders. Remember, a market order is guaranteed to fill. The market is a limit order-driven market. These are all limit orders. So whenever you place an order, let's say to buy 15 at market, what's going to happen? Well, you're trying to buy, so we have to find somebody who is selling. That's why we reference the asking price when we're trying to buy, because these are sellers. So notice that there are not 15 available. We only have 13 available at 310. We can see it right here in the size. So if you wanted to get all 15, we would need to get 13 from this trader and then 2 from this trader. Now that's assuming we don't have a market maker or a ECN or a market making center step in to take up the slack. But this is what's called walking the book. So they might say, all right, we need to pick off both of these trades here, or at least part of this second one here. We'll fill this entire order here, and then we'll take 2 from this trader. That's called a partial fill. That trader is going to get a notification. You've sold 2. You have an open order for 3. What's going to happen now? Now the quote is going to go from 310 to, what's our new lowest offer? It's going to go to 320. What's going to happen to our size down here? It's going to go from 15 by 13 to 15 by 3. So once you understand the way that the limit order book works, you should see why it's very possible that your order doesn't get filled, but your friend does. Or maybe you'll say, hey, I saw some trades go off at $3.10. How come mine didn't get filled? Well, remember, there were only 13 available. So no, not everybody in the world who wanted to buy at 310 can do so. So that's the main thing to understand, is that it is an auction. It's a limit order driven market. So just because you see that some contracts traded at 310 doesn't mean that everybody in the world who wanted to trade them got them. It also depends on where you are in the list. Just like this person right here might say, how come I didn't get filled at 320 when I see that contracts went off at 320? Well, somebody was only trying to buy 15. We needed 2 of yours. They weren't trying to buy the additional 3. So hopefully that makes a little more sense. Just always remember, not saying that mistakes don't happen, but for the most part, if you're seeing that trades have executed at your limit price, but your order didn't get filled, it's simply because of your place in the order book. You just weren't in a place in line, so to speak, where your order was due a fill. Another important point that this highlights, this is why it's so important to get your orders in ahead of time. If you're going to roll an option, let's say you buy a call for $10, turn right around and place that sale of a vertical spread to roll it. That way you're sitting up higher in the order book. So that's another little tactic that can help you make better decisions. And when you make better decisions, you're on your way to making more consistent profits. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsA2Z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.